upwards. Mr. Bajaj, thank you so much for giving us time right here on ET Now. Let me first begin by taking your initial comments on the monetary policy decision as announced by the governor.
Morning, Nayantara. The 50 basis points increase in repo rate that's been announced is a normalization of rates, taking it back to close to where it was pre-pandemic levels. As we know, pandemic just at the start of the pandemic, rates were 5.15%. So we are still 25 basis lower than that. It is a recognition very clearly on the need to control inflation with the tools that RBI has at its disposal. We do know that we are still in a period of global uncertainty, global inflation, and this is impacting us as well. On the other hand, we are not in the same position as the West. We have a strong growing economy, and it is this balance that is important to keep in mind. I'm hopeful that with a good monsoon, as is forecast, and as the RBI said as well, that a large part of our inflation, our consumer inflation, is driven by food prices. So let us hope that comes under control and oil prices stay reasonably range bound so that as India, we still have a strong year of growth.
Mr. Bajaj, you understand the lending business like no one else. So my question to you also is, we just started to see credit growth pick up. It was acknowledged by the governor in his own address today morning. How do you see the rate hike impacting credit growth?
Well, this clearly differs segment to segment. You will probably see a larger transmission of this across retail loans. On the corporate side, a lot of it is driven by availability of good quality lending opportunities, and hence to that extent rate pass on will be more case by case. Overall, I believe that the last couple of years has seen us, because of the pandemic, in a very low interest rate environment, and to that extent this is more a normalizing of that. I don't see the current rate hike as having a significant dampener for credit growth. Good quality projects, and we are seeing many of these new investments in the private sector come up. Good quality projects will get access to capital.
So let me rephrase and ask, at a time when we're seeing corporate India really turn around its capex plans, we've heard of price war in the past, but these days it seems as if between conglomerates there is even a capex war at play. So with the private sector increasing its capex plans, the central exchequer also spending on infrastructure, etc., the corporate loan book of banks and NBFCs may do well, but do you think the retail book could be impacted just given the way there is Mengai, inflation, and now rate hikes?
A lot will depend, Nantara, again on, as I said, food prices and fuel prices in the coming quarters. From a lending institution point of view, whether a bank or an NBFC, it is reasonably common to rebalance your books between large corporate loans and small consumer loans. And you may see some amount of that rebalancing as well in the coming year. Keep also in mind that the middle class is spending increasingly as it's coming out of the pandemic period. And as long as our essential costs are taken care of, we should continue to see this growth. On the other hand, for some reason, if the monsoon is not as normal as it's supposed to be, or if oil prices go up through the roof, naturally that can have its own negative impact on demand.
Mr. Bajaj, if you could help us understand a few of the announcements that came in from the Reserve Bank of India. Retaining the growth forecast, liquidity tightening, rate hike that is taking place, inflation target which is also being raised. How is then growth going to stay intact? Is it going to be a lot more of what you think the growth that's going to come in the second half of the year, primarily the lion's share in the fourth quarter?
I believe, for example, if you see the forecast that RBI has made, you're actually from a low base seeing much higher GDP growth in the first 2 quarters, double-digit growth, and then it starts moderating in quarter three, quarter four. 7.2% is what RBI is talking about. And hence, when we're talking of growth, it's a question of looking at what is this level of growth. If we weren't in the challenging period of the external environment as we are today, there is no reason why we should not have been growing much higher towards the upper end of CII's own forecast of 7.4 to 8.2%. I believe the next 2 quarters is going to be important to take a look at inflation. And as I mentioned earlier, if that remains controlled and if food prices start coming down, you will start to see a lowering in effect of inflation, which is what RBI is predicting for Q3, Q4 as well. A combination of sustained capital investment by the government and new capital investment by the private sector, which is already in process, should then start seeing better quarters for growth beyond these 4 quarters.
Mr. Bajaj, you are the CII president, so let me ask you a question on behalf of for all of India Inc. How do you see profitability and earnings being impacted going forward? Cost of funds is going up. You have inflation as well. We don't know as yet whether it's going to hurt demand. So from the corporate earnings perspective and profitability, what's your assessment?
So let's look at it from 2 points of view. And of course, this differs sector by sector. But when we look at the impact due to current rate hike, I believe you will not see a significant impact on that in corporate profitability. But, excuse me, what is impacting corporate profitability in many sectors is input costs coming and input cost hikes coming in. And you're starting to see some of those prices getting passed on. And that's another reason why inflation is creeping up. But if we are able to ensure a level of growth that is being talked about, you will see corporates balancing this out. You may see some increase in costs to protect margin, but growth will also bring in an expansion on the margin side. I think the important thing for us is to look beyond the next 4 quarters, because in many cases, actions that corporates have already taken are baked into performance in the next 4 quarters. And you will see, you're already starting to see in the fourth quarter some squeezing of margin. But if you're able to get our focus on growth back and keep inflation under control, then you should start to see a combination of margins starting to steady and growth coming back over beyond these 4 quarters.
Mr. Bajaj, if I were to see Mint Street and the indication from bond markets, fastest pace we've seen for hitting that 7.52% for the 10-year yield. It's now, had come down to 7.45% minutes after the RBI governor's speech. As a leading member of India Inc., one who understands financial markets, as CII president, what kind of jugalbandi do you want to see between the Reserve Bank of India and North Block? Because these kind of bond deals are scary, they spook the markets, and the government also doesn't believe they're sustainable.
We basically need to see a clear roadmap like the governor has drawn out today on how they will address inflation, what is the range of inflation they're comfortable with, and you've seen an upward forecast over there for the next 4 quarters. The government, as we have heard recently, remains committed to ensuring that on one hand, it is cut import duties where required to bring costs down, and some of the things like the wheat ban and others takes care of our own food requirements. And we must be realistic that at this point of time, while we're all part of the global world, that every country has to protect its own people first. So we're seeing the government take those measures. It stays committed on new investment as well, particularly on infrastructure. So with these, I would say, actions, both from the central bank and the central government, we are on a reasonably steady path. And as long as we stay on that path, the bond yields will reflect greater stability than anything else.
The next meeting will be in the first week of August. My question to you is, and we're still figuring out the impact of the 50 basis point rate hike, what it'll mean for EMIs, for deposit rates, for corporate book. But I wanted to understand from you, Mr. Bajaj, as we talk of normalization of interest rates, do you think that all of your India Inc. are expecting more rate hikes going forward? You've alluded to that. And can there be a case, just looking at where inflation is, of maybe having higher interest rates than where we were in 2020 pre-COVID?
So again, a lot will depend on where inflation is, and the next couple of months will at least give us a reasonably good idea on food inflation. So it is something that we have to wait and watch. I would say it's reasonable to expect in this year a normalization to rates pre-COVID level. Beyond that will depend on inflation.
And Mr. Bajaj, what would India Inc.'s view be on inflation? Has it peaked out? One seems to have got that sense from today's press conference. Maybe that's why we also saw the reaction that we did in the stock market. But for all of that has been announced today, crude, for example, has been assumed at $105 a barrel. We're once again looking at 120 on our screens. My question is, what is India Inc.'s view? Has it peaked out?
That's a difficult one to call, considering that two main factors. One is oil is outside of our control. It's driven by international prices, as you know, and demand supply. And the second, in many ways, again, is outside of our control, which is to do with food prices. As I mentioned, the next 60 days should give us a much better clue on food prices. I am hopeful with a good monsoon that we see that moderating fruits, vegetables. Once those starts moderating, it can itself have a reasonably good impact on inflation, which leaves only oil as a big uncertainty, which is very difficult to predict. So we will have to wait and watch.
My final question to you, Mr. Bajaj, before we get to your sister concern, ET Nas Swadesh, for just 2 to 3 questions. And that is, you have a sense of what financial markets behave like, what they do. We had 40 bips hike on 4th of May, even before the RBI didn't want to wait for the FOMC outcome. Now a 50 bips rate hike has been announced. Do you think all of this is going to be passed on to the consumers? And do you think that's for the borrowing and the EMIs? And do you think deposit rates also go up in tandem?
This again will depend sector by sector. I believe that greater chance of at least part of it being passed on in the retail products. Again, longer term loans like housing loans, we're already starting to see announcements on rates getting passed on. How much of it will depend on the bandwidth for each institution. And correspondingly, you should see deposit rates also inching up. Again, you've started to hear about it already even today. As far as MSME and the corporate book is concerned, here again, in the last 3 or 4 years, you've actually seen reduced exposure from the lending system through the pandemic period and even a few years prior to that. So you will see lending institutions starting to increase their exposure here, and that's where rates could be more competitive.
Do you think it'll impact capital flows?
Well, this will differ again, as I said, sector by sector. But if I understood your question right, I believe that we are in a period of strong secular growth. And if you show that growth, capital will flow back.
Mr. Bajaj, it's been an absolute pleasure talking to you. This is the CII President, Sanjiv Bajaj, also the top boss of Bajaj FinServ, only on ET Now, with his reaction on the second rate hike that you've seen in a month. Second rate hike that we've seen after the 4th of May, 50 basis point rate hike, accommodative stance that has been maintained, along with the growth forecast also being kept intact. Thanks for tuning in.